So guys, if you're looking to get the most bang for your buck when it comes to dividend investing, then you clicked on the right video, because today we're diving into 3 ultra high yield dividend stocks that I think look like solid buys right now. And just so we're all on the same page here, when I say ultra high yield, I'm talking about double digit yields, like 10% and above. So you can really turbocharge your dividend income by investing in each of these 3 stocks. But here's the catch, guys. With great yield often comes great risk. And if you're not careful, those double digit yielders that you think will fast track you to financial freedom might end up just being big fat yield traps, and you definitely don't want that. So with that in mind, I'm not just sharing the stocks with the highest yield. The stocks that we're going to be talking about today, I think offer a solid balance between yield, reliability, and also growth, because that's important too. You want the stocks that you own to continue to increase their dividend payments over time. At any rate, guys, before we get into all of that, I want to hear from you. Leave me a comment below and let me know, what are some of the highest yielding dividend stocks in your portfolio? I'd be curious to hear if we have any of the same ones. Now guys, Blue Owl Capital Corporation is the second largest publicly traded business development company, or BDC, in the market today. And if you're not familiar with what a BDC is, it's basically a company that lends money to or invests in privately held businesses, and typically these tend to be smaller or mid-sized businesses that can't or don't want to go their traditional bank route when it comes to financing. And in Blue Owl's case, they tend to focus on non-cyclical, recession-resistant industries like insurance and healthcare. And 97% of their debt investments are floating rate, which means the interest income they collect goes up when interest rates go up. And that's a big reason why this company has done so well and has been able to pay out so much to shareholders in this higher interest rate environment. Now, taking a look at the dividend stats over here on Snapstock, we can see that Blue Owl's yield is incredibly high and looks to just be getting higher and higher with time. Right now, you could lock in about a 12% yield, which is just off the charts. And if we look at the dividend per share chart over here, it looks like at least for the last few years, they've done a really good job of increasing the payouts. And one of the cool things about Blue Owl is that all that extra income they've been able to generate has allowed them to issue special dividends every quarter over the last few years on top of the regular dividend. And the cherry on top is that they've grown that dividend nearly 10% every year over the last few years. Not to mention, that dividend looks to be very well covered. At least over the last year, the net investment income they're generating is about 20 to 30% higher than what they're paying out in dividends. Now guys, out of the 3 companies that we're talking about today, this is the only one that I actually have in my own portfolio. And if we take a look at my position over here using my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But here guys, we can see I have 130 shares at an average cost of $13.50 per share or so. With the current share price about $1 above that, that's going to leave me up about 7% just looking at the share price return. So really nothing too crazy there, but including dividends with as high of a yield as Blue Owl does, that really packs a punch. On a total return basis, I'm up 41.4%. And I'll tell you what, I would not mind adding a bit more to this company myself. I mean, it only makes up about 2.4% of my total portfolio, so there's definitely room here to increase the position. I'm not at any risk of it being overweight anytime soon. So guys, next up is Hercules Capital, which, like Blue Owl, is a business development company, but with a slightly different twist. Unlike Blue Owl, which is externally managed, Hercules Capital is internally managed. What that means is that the people running the business are actual employees of the company and are not hired out from like a third-party management company. That can lead to better alignment with shareholders and therefore more consistent long-term decision-making. It's a great thing. Not to mention there are fewer costs involved since you don't have to pay any management fees. Now, as far as their portfolio goes, Hercules aims to be at the center stage of the innovation economy. And so they primarily focus on venture-backed companies in high-growth potential industries like technology and life sciences. You should recognize some of the companies they work with here, ones like Lyft, SeatGeek, and Impossible. Those should all be pretty familiar. Having said that, their focus on early-stage tech companies could come with more risk, but at the same time, that elevated level of risk comes with the potential for higher returns. And historically, they've walked this line, I think, in perfect stride and have grown their net investment income by about 16% every year for the past decade. That's pretty substantial. And looking at the dividend stats over here with Hercules, you're getting a slightly lower yield than with Blue Owl. I mean, 10.8% or so, but still we're getting a double-digit yield. This is pretty sweet. And looking at the chart here, we can see that historically Hercules has been a very nice dividend grower, and on average over the last 5 years, years, they've increased the dividend by an average rate of 8.6%. Also, like Blue Owl, Hercules has paid out special dividends every quarter, and they've consistently increased their payouts for the past 8 years, which I think is a solid track record, really for any company, but especially one with a dividend yield as high as this one. So guys, last but not least, we have Delek Logistics Partners, which unlike the last two companies, this one is not a BDC. It's not a business development company. It's a midstream energy company that is structured as a master limited partnership, or an MLP. And there are a couple important things to note about MLPs because they are slightly different than your normal company in terms of how they're structured and how they're taxed. First and foremost, some of the terms that we'll use for MLPs are a bit different. For example, shares are called units, and therefore shareholders are unit holders. Also, dividends from MLPs are called distributions. And for our purposes, I mean, all of these things are pretty much just different names for the same thing. It's kind of just tomato, basically. And the most important thing that you'll want to know about MLPs is that the distributions you receive at the end of the year are reported on a completely separate document from all of your other dividends. Instead of them showing up on a 1099 form you get from your brokerage at the end of the year, the company will send you a Schedule K1 form that details your distributions received from being a unit holder of the company. And this is one thing that, at least from what I've seen, steers a lot of people away from investing in master limited partnerships, because at the end of the year, come tax time, this is a whole extra document that you have to report. And taxes are as complicated enough as it is already. Personally speaking, though, this extra form has always been relatively easy for me to deal with. I mean, these days I do have someone handle my taxes for me, so I don't really have to worry about it. But prior to that, I did all my own taxes through TurboTax, and adding this extra form in there maybe only took an extra few minutes. It really wasn't that big of a deal. But anyway, back to DKL. As a midstream energy company, they handle the boring but essential work of transporting oil and refined products around the country, which they do through their 850-mile network of pipelines and storage tanks. And more recently, the company has also taken on water logistics in places like the Permian Basin. And looking at the dividend stats, guys, DKL has got it going on. We're getting about an 11% yield, so another very high double-digit yield. And this dividend growth chart is looking very good. We can see the dividend growth here has been very consistent, and on average over the last 5 years, they've raised the dividend by about 5%. And based on the distribution coverage ratio, which compares how much distributable cash flow the company is generating relative to how much it's paying out in distributions, we can see that the dividend is very well covered. That number is typically between 1.2 and 1.4 times, which leads me to believe the dividend is totally safe, even with such a high yield. Now, like I mentioned earlier, out of all three of these companies, the only one that I personally own is Blue Owl Capital Corporation, but I think all three of them are solid bets if you're looking to turbocharge your dividend income. With that said, though, these three are not the only ones. Here are some honorable mentions that I think are also worth considering if you're looking for some safe, higher yielding investments. And you guys will probably recognize all of these. I mean, Ares Capital right there at the top. ARCC is another very popular business development company. Really high yield too at 9.1% with a near 4% dividend growth rate. That's not too bad. And then we also have EPD on this list, Enterprise Products Partners, which like DKL is a master limited partnership. And I also have this one in my portfolio as well. It's been really awesome. It's actually a dividend aristocrat. They've been growing the dividend for more than 25 years, which is very impressive considering how high this yield is, almost 7%. And even though I'm not personally a huge fan of covered call ETFs, I don't own any in my portfolio, I do think that JEPI and JEPQ are two of the better ones that you could consider, and they both have very juicy yields. 8.1% for JEPI, 11.5% for JEPQ. And even though they do pay variable dividends, which means that the distributions go up and down every month just depending on how successful their option strategy is. Historically, JEPI and JEPQ have delivered very solid returns for shareholders, so I do think that they are worth mentioning here in this video about high yield stocks. And I know they're ETFs, but it still counts. And then guys, KRC is another pretty solid high yielder. I mean, admittedly, the share price performance has really been all over the place, but the dividend's been very consistent. Right now, the yield is very high too at 6.8%, and the dividend is pretty well covered. I think their FFO payout ratio is under 50% still, so it doesn't look to be at any risk of being cut anytime soon, so long as they can maintain that. And you'll probably know Main Street Capital Corporation. This is the most prominent and most popular business development company, and it's also a monthly payer, so really solid one to own. You're getting about an 8% yield and a dividend growth rate that's not too bad either, just below 4%. And then guys, we've got the only dividend king on our list right here next. This is Altria Group coming in hot with a near 7% yield and 4% dividend growth rate, and they have been increasing their dividend every single year for more than 50 years. And then guys, the second to last stock is one that I don't know if I've ever talked about before on my channel, but this is National Storage Affiliates Trust, which as we can see is double trouble in the dividend department. This is a real estate investment trust, and right now you can lock in a 6.2% yield with an 11.7% 5-year growth rate. So these are pretty sweet dividend stats. I felt like I had to mention this one. And then last but not least, we've got one of my favorite companies, Vici Properties, with a 5.4% yield and also a pretty high dividend growth rate considering how high the yield is at 7.7%. So I think Vici is also double trouble here in the dividend department. So I think all of those are looking pretty good, guys. And if you want to hear about some more high yield dividend stocks you should definitely not buy, then check out this next video right over here. These dividend stocks are terrible, guys, let me tell you, and you should avoid them at all costs. Click right over here to find out which ones they are, and I'll see you in the next one.